The next portion of the contract is whether or not it's on a loss occurrences basis. Is it risk attaching? Is it losses occurring during? Is it losses occurring on risk attaching? And that's really a business unit decision as to how they want the treaty to be written. Quota share treaties are typically on a risk attaching basis. XOL treaties are typically on a losses occurring or loss occurrence basis. You want to make sure you get in, if your definition of loss or UNL or net loss, your definition of loss expenses, specifically the exclusions that are applicable to the business. And you need some thought as to those, because a lot of times it's not a one-size-fits-all to your exclusions, and they should be specifically looked at and in conjunction with the business unit for each contract. You need to determine whether or not you want ECO, XPL cover, and we'll discuss that a little bit later. And then I think there's a presentation later this afternoon on that same topic. And you want to make sure that when premium is going to be ceded, the time period for claims to be paid, whether or not that you want a penalty provision if claims are paid late or premium is paid late as well.
I think just to talk a little bit about the definitions that Deborah was mentioning of covering loss expense and ultimate net loss. And typically in the contract, the limits and retentions will be either based per risk, per occurrence, per event, or some other term, and it'll be often in terms of ultimate net loss. All of these terms are things that you really need to define in the contract. Not having some of these terms defined in the insurance policy led to the World Trade Center, obviously, the absence of an occurrence definition. So one of the things that we've actually made a lot of progress in the industry since 2001 is having that specificity in those definitions in the contract. Loss occurrence is obviously typically one or a series of related losses arising from a common cause or a common event, depending on if you have property cover or casualty cover or a cat cover. You can't just plop any occurrence definition into any line of business. Casualty will usually refer to a common cause, where property will refer to a specific event. It might have hours, durations, or geographic limitations. And the underwriter involved in that should be looking pretty closely at whether those hours are consistent with how the business is priced and how it's put together, how many occurrences can arise from a single hurricane. Sometimes the occurrence definition will allow for multiple occurrences from one hurricane, sometimes only one. Then the limits and retention are all often measured in terms of ultimate net loss. And this is a term that I'm sure is familiar to almost everybody in the room, but it's not defined the same way in every contract. This is just a sample Burma definition, which is actual loss, including loss adjustment expenses that are paid or to be paid by the company. Sometimes it's paid or just paid losses. Sometimes it's advanced losses, and that may make a difference in the company's cash flow, the reinsurer's cash flow, and how and when claims are paid. Will ultimate net loss include loss adjustment expenses? Will ultimate net loss also include extra contractual obligations or XPL, loss in excess of policy limits? If all this stuff is part of ultimate net loss, it'll probably be within the limits of the reinsurance. If it's not part of ultimate net loss and it's a cover, it might be additional coverage in addition to those limits.